What's happening in the world of finance? The Intuition Finance Digest gives you a unique take on the industry's major trends. The second EU Payment Services Directive, called the PSD2, builds on the first such directive, the PSD1, by providing for the further development of a better integrated internal market for electronic payments across the EU. PSD2 puts in place a comprehensive framework for payment services with the objective of making payments within the EU more efficient and secure. The directive also aims to provide greater consumer protection by enhancing security measures for electronic payments. It seeks to open up payment markets to new entrants to encourage more competition. The fragmented nature of Europe's payments markets has long been an irritation for those who would wish to see a more integrated European economy. Added to that, the dominant role of major foreign card schemes such as Visa and MasterCard made new legislation for a more efficient and less costly European payments market an imperative for European authorities. The first EU Payment Services Directive, or the PSD1, published in 2007, was intended to become the legal framework for all payment services within the EU and the European Economic Area. PSD1 also provided a legal platform for the Single European Payments Area, or the SEPA. The overriding objectives of PSD1 were to promote competition by opening up the market for payment services across the continent and to make cross border payments as easy, efficient, and secure as making payment within an EU state. Prior to PSD1, banks had traditionally dominated payment services in Europe. A major innovation of the directive was the introduction of a new legal form of payment service provider, known as the payment institution. Unlike banks, payment institutions are not permitted to take deposits from the public. They can only have access to customer funds when making payments on their behalf. In addition to payment institutions, the directive also defines the following categories of payment services provider: credit institutions, e money institutions, post office gyro institutions, the European Central Bank and national central banks, and government ministries. A review of PSD1 in 2012 found that while some of the directive's objectives had been achieved, there were still several challenges, namely, an insufficient number of new providers were entering the market, and the cost of payments to users was not falling significantly. Payment institutions were still reliant on banks to help them offer their services. PSD1 only covered payments within the EU, and the intervening years had seen the introduction of many innovative payments products not catered for by the directive. These factors gave rise to the second Payment Services Directive, the PSD2, a revised and complete version of existing and new rules. PSD2 came into force in January 2016 and was applicable from January 2018. PSD2 set about eliminating the shortcomings of PSD1 by extending powers in three areas. First, it introduced so called third party providers that would be permitted to provide certain types of services related to payments. Second, it introduced strict security requirements for the initiation and processing of electronic payments and for the protection of customers' financial data. And third, it extended the scope of PSD1 to transactions in all currencies and to payments where only one provider or party is located in the EU or the EEA. PSD2 has proved to be transformational, not just in Europe, but potentially elsewhere. Among other things, PSD2 gives third parties access to bank customer data and ushers in a new era of so called open banking. The content for this podcast is taken directly from Intuition Know How, the world's premier digital learning solution for finance. Intuition Know How is written by financial experts and looks at not only foundational topics, but also emerging areas such as crypto, sustainable finance, and AI. If you'd like to learn more about Intuition Know How, visit intuition.com/know-how.